Hello and welcome to the July 2025 market update. We're going to jump right in. Some interesting numbers as we get towards the end of summer here. So let's take a look at what we got. As always, it's the 5-county area that we're looking at, including Wake, Durham, Johnston, Orange, and Chatham counties. So in July 2025, new listings were up 21.5%. You can see the gross numbers there on the screen. We had just under 3,500 new listings coming on the market. Year to date, new listings hitting the market is up over 15.5%. That's a good thing. We'll look at some numbers compared to previous years in just a few minutes. But we still have plenty of room and runway for more listings coming on the market and more inventory. Closed sales was actually up in July, which is nice. It was up a pretty decent clip over 2024, up by 11%. As you can see, we're just coming a little under 2,700 closings in July for this 5-county area. Year to date, this is a big number here. We're actually now, year to date, we're up for closed transactions over 2024, 0.6%. So it's not a lot, but this is the first time that on a cumulative year to date basis, we have surpassed closed sales compared to 2024. So year to date gross numbers, we're looking at just under 16,000 closed transactions for that 5-county area. Now in July, the median sales price was up 2.2%. But if we look year to date, it's just up 0.4%. We're at 452 as a median sale price year to date. That's almost flat. So being up 0.4% is fine. I would actually suggest that hopefully we can end the year no higher than that. Staying flat is probably a good thing for our market to prevent the need for prices to really fall off. We'll talk more about that in a minute. And then percent of list price received is 98.8%. So just an indication, don't read too much into that, but just an indication there is still negotiating room in our market. All right, so inventory levels, this is the same kind of trend we're seeing, this 40 to 50% increase year over year. Inventory up 48.5% in July. And so that inventory level point in time was 7,885. If you compare that to the same time last year, where it was just over 5,300. So obviously a pretty significant jump there, almost 50%. But again, our gross inventory levels are not out of whack right now. So if you see headlines about inventory spiking, don't let that 48.5% number scare you or anyone that you're talking to, because the gross numbers, as we'll see in a minute, are definitely not out of whack. We're still short on inventory levels right now. Month supply at 3 months. If you look at the same time period last year, we were at 2.2 months of inventory. And so this is basically, if no more houses came on the market, how long would it take to sell everything off? And 3 months is not out of balance. That's actually somewhere approaching a balanced market. So that's a good thing. What we need is we need inventory to continue going up. We need closed transactions to continue going up. We need to keep those things in balance. And of course, interest rates are going to play a role in that, but we'll talk more about that in just a minute. So let's compare all of this back to July of 2019. So, I like to do this to look at what the most recent pre-COVID market was like. Now, if you were around selling back in 2019, you will remember that inventory levels felt really constrained. You may have had a large pipeline of people wanting to buy a house, and you were not able to find them a house to buy. So that was the kind of feeling of the market back in 2019. So inventory levels back then, 8,440. So if we compare that to where we are today, we're at 7,885. So you can see we're still well short of where we were, maybe 8% short of where we were back in July of 2019. The supply of inventory was at 2.4 months, so a little bit lower, just a product of more active buyers in the market at that point. Median sale price at $295. So again, if we were to forecast a normal, I'm putting normal in quotes, a normal appreciation rate of 5.5%, what would that price have been today? 6 years later, it would be $406,758. Well, you can see our median price is $464,950 for July, or $452 year to date. So if we were to apply the same appreciation, forward 2 more years. So again, this represents where the median price would have been in 2025 had we not had the COVID spike and we were just a straight line 5.5% appreciation. So if we were to take that out 2 more years, so 2026, 2027, it would put you right at $452,000. So what that means is, I mentioned that we want to see this year to date, this median sale price. If we can see that flat this year, and we can see that flat in 2026, and we can see that flat in 2027. I know I'm reaching here, but that means that prices would actually then, come July of 2027, then prices would be where we would have expected them to be had we not seen those 20% plus spikes that we saw in 2020, 2021, and into 2022. One of two things hopefully will either happen. Either prices will remain flat for the next couple of years. We may, as we get into 2026 and we're looking backwards, we might see that prices actually were falling more in 2025 than we knew, because again, the same houses aren't selling. So it's not the same set of homes that sold in 2024 selling in 2025. So what you can see sometimes is it looks like year to date prices are going up. But if you were to look at the price per square foot, you would actually see that it is down year to date by 0.4%. So it's not the same home selling. So it's not a perfect science here to say whether prices are going up or going down. I think we'll see in 2026 if, in fact, prices are falling maybe more than we realize in 2025. For those of you out there listing homes and selling homes right now, you might be raising your hand saying, yeah, prices are falling right now. There's a lot of price reductions. So we'll see where this all shakes out as we get into looking in the rearview mirror next year. But either prices need to fall a little bit or remain flat for the next year or two. That'll put us back into a pricing balance where we would have been without the spikes. So to finish this off, let's look at new listings. Back in July 2019, 3,668. You can see this year in July, we were at 3,452. So still short, but we're catching back up to adding the new listings each month that we need to be adding. So we just need to see that continue. And then closed sales, this is where the big differentiator is, and this is why the market feels so tough for everyone out there. Closed sales were up over 3,500 in 2019. We were only under 2,700 in July of this year. So year-to-date numbers, another way to look at it, 15,868 is what we've had this year through July in that 5-county area. And that same area in 2019, we were up over 20,500. So a lot fewer sales have happened this year. But again, if there's the good news, you look at this, we finally kind of crossed that bridge. We surpassed 2024 numbers. And I'll show you a chart here in just a minute to kind of help you visualize that. So again, just looking at inventory as gross numbers, we expect inventory to climb. Usually in our market, it's going to peak somewhere between April and June, just depending on the year. Bottoms out in December. What we saw last year, and this will be more prevalent, I'll show you on this chart. What we saw last year is that inventory continued to rise actually all the way until October. And then as you approach the holidays, naturally, people start to take their house off the market. Fewer people are putting it on. So you see inventory falling here. Usually in quote normal markets, this peak that we saw last year in October would have been earlier in the year. We actually would see inventory levels rising, maybe through April, May, June. And then we start to see it come off towards the end of summer. And then fall off as we get to the end of the year. But this year, we're seeing kind of a flattening out a little bit. Now, time will tell. We'll see what August brings. But you can see the trajectory from June to July of last year was a little more steep than it was from June to July of this year. So that may mean that we're seeing a flattening of inventory, and we may see that fall off happen a little bit sooner, the peak happen a little bit sooner in the year. We'll see what happens. Actually would not be the end of the world if we saw a similar trajectory and we had inventory just slightly, because you can see here in August of last year, the trajectory flattened out some. It just kept climbing in September and October, but by much smaller percentages. If we saw something similar this year, that actually would not be a terrible thing, because we do need more inventory in the market. We don't have too much inventory. That's not why homes are sitting. That's not a supply issue that we have. It's a demand issue. So we need to see supply continue to rise along with that demand. So, of course, we know that demand will rise when interest rates begin to fall. All right, so this is a lot of gross data. I'm not going to hang out here long, but this really data is here just so that I can get it into a chart for you. But this just shows closed sales from 2024, 2025, and then also we're going to put in there for you 2019, so you can see what that most recent pre-COVID market was like. And here's the visualization for you, which I always think is really interesting as you look at the last 4 months of the year. But the blue line represents 2019. So you can see the major gap that we have in terms of closed transactions. And I don't think there's any question that we have more humans living in our area, more people here than we did in 2019. And so seems like we should have more transactions if everything was operating in a healthy, normal way. But of course, we know that's not where we are right now. So this is kind of our goal of where we want to get back to. It'll be nice when I can show you one of these line charts eventually. Don't expect it for another maybe couple of years, but eventually we will get above this 2019 level. But what's interesting here, this is looking at year over year for each month. And so beginning in May, we got month over month, or year over year, I should say, we were surpassing 2024 numbers. So that's great. I'm going to show you a cumulative chart here in a second. But the thing I want to point out is that it's always normal to see closed transactions fall off in September. And the reason is showing activity, which we don't have a chart for that, but showing activity in our market tanks in August. There are a lot fewer people looking at homes in August. Lots of reasons, end of summer vacation, back to school, lots of things going on there that cause that. But you see that every year. So this fall off of closed transactions always happens in September because there were fewer people looking and going under contract in August. Then you see this bounce back in October because now people are back to school, summer vacations are over, they start their house hunting again. And we always see this little bounce back come October. No reason we shouldn't see something similar this year. So, again, time will tell. And then you get a little bounce at the end of the year in December because builders who have their fiscal year ends are trying to get stuff closed, and resellers. So buyers and sellers who are looking at this time of the year are generally more motivated and have a reason that they're on the market or in the market at that point. And so you just naturally see that bounce in December. So then, of course, we'll typically see a fall off. If you look at 2024, here we were just over 2,000 transactions in December, and then under 1,500 come January, or just over 1,500 in January. So you'll see a really significant drop off from December to January as well. All normal stuff there. So it'd be really fun to watch this green line as we get through the end of the year. But now let's look at this as a cumulative. So this is year to date at each one of these month intervals. For this one, I included 2019. 2021. 2021 is this orange line. So this is our Hall of Fame year. This is the record-breaking year of closed transactions, as well as price growth, but that's neither here nor there. But closed transactions, that's our orange line from 2021, the peak COVID year. The blue line then represents 2019. So again, this is kind of our benchmark of where we want to get back to and then hopefully surpass on a regular basis once we get back to a normal churn in our market. And then we have the green line representing 2024. Now, what you'll notice, it's tough because the numbers are so close from 2024 to 2025. But if you look closely, the red dot here was just below the green dot in June. So cumulative year to date, even though month over month, June had more closings in 2025 than in 2024, we were still playing catch up from a year to date basis. But then in July, that's when we surpassed it for the first time this year. Other than in January, which doesn't count, that's just 1 month. But we passed it year over year, cumulative in July. And so again, we are hoping that trend continues. And then in 2026, we will hopefully bridge more of this gap up to the blue line here. So really cool to see that surpass 2024, and we hope to continue that trajectory. Now, this ratio I like to look at here, which is the new listings to closings ratio. This just tells you how many listings do you need to take in order for one to sell. So if you're new to us, I'll just quickly point out, you can easily see here back in the Great Recession, you had to list more than 2 houses in order to sell one. So 50% of the houses that were listed were in fact not going to sell. That was the world that we existed in back then. The market then continued to get healthier and healthier and healthier all the way to 2021, where basically, for all intents and purposes, every house that got listed sold. We then came out of that unreal market that we had in those months. And we've seen that ratio start to go up. So think of this as kind of how painful does it feel for sellers, because this indicates that more houses are in fact not going to sell. So it's not necessarily an indication of how it feels for buyers, because buyers right now also feel a lot of pain, and sellers feel a lot of pain. So we're hoping to get, with interest rates coming down, to kind of eliminate that double pain that everybody's feeling. But basically think of this right now. Now this ratio has been coming down steadily all year. I anticipate it will end somewhere between 1.4, 1.5 houses needed to be listed in order to sell one. So think of this as for every 6 houses that you list, you're going to sell 4 of them. So think of that from a business planning perspective. You've got to understand every house you list isn't going to sell. Now, you may be saying, well, every house I list sells. Well, that may be good. Your sample size may not be large enough to really reflect the reality of the market. So if you list 6 houses over the course of the year, and all 6 of them sell, well, that's just not a large enough sample size. If you were to list 60 houses or 160 houses, you'll start to see this ratio take effect. So just be aware of that. The lower this number is, the less painful it is for sellers. The higher it is, the more painful. Again, we should end lower than 1.5 this year would be my expectation. And then last thing, final slide here is home affordability. Not a lot of great news, but I will just give you one silver lining here, which is that July, we were at 72. Well, that is actually the best affordability we've had in July since 2022. Now in 2022, home affordability was, I think, 81 or 82. It was on the way down, of course, because the last time we were over 100 was March. Well, I guess it was actually February of 2022. We've been under 100 since March 2022. But the silver lining is that this is the best affordability in July we've had in 2 years or 3 years, I should say. But it's still, of course, really painful. We need to see this approaching, and we need to see this trajectory get back towards approaching 100. And that is mostly going to be driven by interest rates. That's going to dictate affordability. So what I will say here is what we want in a perfect world is interest rates to come down. That's going to increase our demand, okay, because buyers are going to come back into the market as interest rates fall. But we also need inventory levels to continue rising. So we need that supply, which is our inventory levels of houses, to rise, along with our demand, the number of buyers in the market, to rise. We need both of those to go up. And if we have that relationship, then prices aren't going to spike. You hear a lot of people talking about, well, you don't want to wait until rates come down because then more buyers are going to be in the market. That's going to cause prices to spike. So your interest rate's lower, but your price is higher. Well, we hope that's actually not the case. And I think that's a little bit misleading, because if inventory levels also rise along with the number of buyers in the market rising, then that relationship is not going to cause prices to go up. Okay, because inventory levels, month supply of inventory, those things, if they remain elevated or at least in a balanced area, like that 3 months where we are right now, then prices don't go up. They don't go up dramatically anyway. The only reason they go up dramatically like they did in 2021 is because the inventory level was so low and the number of buyers in. So supply was low, demand was high. If both supply and demand are rising together, prices can remain flat or just increase moderately, which is where we want to be in this perfect world. This soft landing, so to speak, would be interest rates come down, inventory continues to go up, buyer supply or buyer demand rather goes up. We see more churn, more closings, more transactions, and yet days on market and inventory levels and supply of demand or of inventory stays about where it is right now. So that's what we're hoping for. We'll continue to watch that. And next month in September, we'll see the Fed meet and either keep rates the same or drop them. We'll see how that impacts mortgage rates, and we'll go from there. So looking forward to next month's. As always, if you have questions about the market or anything else real estate related, don't hesitate to reach out to us here at Choice Residential. We love talking real estate. All right. Thanks, everybody. See you next month.